guys. This is Peterson Wealth Services Point of View. Hey, so the boys and I thought we'd take just a few minutes today to enlighten you on recent market events. We know that we've survived this recent volatility. The VIX, the volatility index is what that actually stands for, spiked sharply just a week ago. And it seems like it's already long gone and forgotten. We have already put out a video on that and talked at length about, staying invested and these things are normal and expect these types of corrections. But we wanted to take just a few minutes today. We were caught up and we wanted to send out another little sound bite on some things that we think why this happened and maybe what people are concerned about even after that and the recovery's all actually been restored in prices. But it's not broadening out as much as far as that correction. It actually has rebounded and done pretty darn well. So we thought we'd give you an idea of why this occurred. First and foremost, in my mind, it was just kind of like a perfect storm where you had valuations a little high. Then you had some media outlets and some economists starting to talk about recession. A lot of people didn't know what to do with that because they thought, hey, we're already counting on this soft landing. And we're already counting on the Fed to cut rates, but economic reports were not giving us a whole lot of confidence that the Fed can even cut rates yet. And we still have an inflation problem, even though everyone says inflation is gone. It's still out there.
And
then the third thing in my mind,
Buffett raised cash too. Everyone was up in arms about that.
That's right.
A guy can't ever take a profit on some of his investments.
No one wants to do that because then you have taxes to pay.
Yeah. What was the third thing? Sorry.
The third thing I was going to say real quick is, Warren Buffett talk about cash, Shaun. He's sitting on more cash than I think he's ever had, and he sold half his stake in Apple. So that raised a lot of eyebrows. They're thinking, well, this supposedly the smartest investor in the world is dumping one of the best companies ever known, and he's dumped half of it. But he's still, I think, the largest shareholder of Apple, if I recall right. He still owns a ton of it. He's just had such a huge increase in value. It's kind of contradictory for Warren Buffett in my mind because he always preaches buy and hold, never sell anything. Right. And so for him and his company to be selling and just sitting on piles of cash. Actually, I saw that interesting statistic. Berkshire Hathaway, his company, owns more treasury bonds than the U.S. Federal Reserve. God. It's a pile. It's an unbelievable amount of money. The guy, like $260 billion he has in treasuries.
I wonder, though, they say record levels of cash. Is that cash or is that a percentage of his portfolio? I bet it's cash.
Well, it's supposed to be cash. He's in these bonds, short-term investments like that. And he interestingly, he's buying the treasuries, not necessarily the shorter-term money market where everyone's...
He's getting out there a little bit on the
he's wanting to lock it in versus just buying that money market. And, a lot of people are talking about money market, 5.3 or 4%. But as we all expect, rates are going to start dropping as soon as they cut rates, as soon as the Federal Reserve does what they've been telling us they're going to do, which is cut rates. I don't know how quickly they're going to be able to do it because they're still pretty reserved on their commentary.
Yeah. I wrote about that money market trap in our newsletter. So if you guys haven't read that, little nice article for you to get updated on money markets. But
little plug there.
Why did it all rebound? I mean, we've shown people the charts that usually the best days come right after the worst days. And this is kind of a prime example of that. So was it just everybody calmed down, the dust settled, everyone come back, the stampede was over?
You start to wonder how this volatility plays out. And when you start, sometimes it's the cards start to fall apart and then it all goes quick. But there's still enough earnings power to hold the market together, and there's enough buyers who are still trying to do what's called buy the dip. And so whenever you have a correction, quite a few people are still putting money to work. When I say quite a few, I mean millions of people, and a lot of institutional money goes back in. So it was like calm down. A lot of people reassured the market that it's going to be okay. And they also looked at the Fed and said, they're going to also be there to save us, so to speak, when they're cutting rates. So even though the recession was maybe a one-day wonder, it was like 1,000-point drop.
Yeah.
And that's what caught everyone's attention is the headline 1,000 points. But we always tell people, remember, 1,000 points on 30,000 is nowhere near the impact of 1,000 points on 10,000.
Yeah. Percentage wise.
What the Dow used to be trading at. So just get used to these big numbers. I don't care about the numbers. I care about the percentages. So a lot of people say, how much was the market up or down? They want to know the points. Talk percentages.
Yeah.
Okay. Then it makes more sense.
Yeah, well, Shaun was right about the best days after the worst. And if you wanted to get out, which we got several phone calls that day when it was the big drop, but it was the very next day or a couple days later, the S&P had its best day in 2 years.
Yeah.
So if you did get out, it was a big mistake.
Yeah. And there's so much money market on the sidelines waiting to come back in. I think it's $6 trillion in money market funds right now, which is a huge number. We were in a client meeting yesterday, Cade and I, and they brought up a good point because it was part of this sell-off is this AI boom, is this tech boom, is it ran too far? Is it a bubble, basically, is what they were asking. And Billy, I've heard you share the example because I know you were around in this time in this business in 2000, the tech bubble that happened, late 90s, early 2000s. And the difference is, if you were either there or you've studied it, that this time around, these companies, at least the ones we're looking at, they have earnings. They have sustainable earnings. They've got good management teams. They actually have a product that people are using versus back in the early 2000s where dogs.com or whatever one I've used is 1-800-flowers.com. I think they're still around, but I don't think they ever got any traction. But just these fly-by-night companies with no earnings, no management team. It's like on Wolf of Wall Street, the two guys that just started a public company out of their mom's backyard. So it was those type of companies versus what we've got now with these more stable type tech companies. So I think that's the big difference that people need to understand. And there was some worry like, hey, these companies invested so much money in AI. Is it going to pay off? Earnings are maybe coming in a little bit slower, but that's maybe just part of this consolidation or this slowdown we've seen in the economy because of higher interest rates like we've seen. So does not signal, I think, a tech bubble like we saw way back in the day. But
some of the Magnificent Seven, probably the argument could be made that they're ahead of themselves.
Sure.
The earnings are still coming in. And that's the interesting part is investors are glued now to the earnings reports. And we just finished up this second quarter earnings season. So it's behind us. Now we're moving on to the next quarter. But every quarter from here on out for the next several years is going to be really, really dialed in and critical on the report and also the guidance. The
guidance is huge.
Really what the company's seeing going forward. And any kind of a misstep in earnings or in what they expect and what they're projecting for the next quarter, I think those companies are just going to get smashed and just beaten up. No question. They're just going to ask questions later. Just everybody run for the exit. Those kind of days create opportunity for the people who want to maybe buy more into those shares, buy companies, good quality long-term companies. But we know those earnings are going to have to moderate. You cannot keep growing at 50%, 60% per year once you get to a certain size. I mean, size dwindles the percentage growth over time. You cannot continue to double your earnings every 2 or 3 years.
Yeah, you shift style boxes. You go from a growth company to maybe more of a value or a blend type of company. Yeah. Start paying a dividend or something like that. Some of these companies.
Yeah. I mean, think about Apple. I mean, when I got into this business, Apple was a tiny little company and just started out with it as a computer company. And they had the Macintosh. And it was kind of like a cult following back then. And then they
still created, is now.
it is to a certain extent. But they created the iPod. Right? What was that? That had the music.
The twist, the iPod.
Is that
you would scroll through your music and they go
what they have too many eyes.
Yeah.
But they created that to where you could have your music with you and pack it, so your portable music. And everybody back, I still remember I was a big runner back in those days. And hell, I remember strap up this big old CD freaking pack to my waist and run around with that.
And it would skip.
It would skip all the time. But now it's so much better, and the technology's improved. But Apple was right at the front and center of that. And then, of course, when they came out with the phone, and they just dominated the competition. So think about Apple from where it was, pretty small company back when I got into this business, to a medium-sized company, then to a large, then to the biggest company in the world.
At one point, yeah.
And if you were there along that ride, you made a fortune. I mean, we have clients who've owned those shares for some 10 years, some 20 years, some even longer. And it's just been a wealth-building machine.
Yeah. But there were times, I'm sure, when people thought Apple's done. Bad earnings report, bad guidance, recession, tech bubble. And that's why we always drive home. Like, you gotta buy and hold.
Think about those clients who might have sold when they got nervous on it.
They gotta be sick. Well, one of the partners or founders sold for nothing, right?
Yeah.
And it was minimal that he got.
He just didn't think it was ever going to materialize. He said, I'm going to get out.
Can't remember his name, but that happened.
But we know some people who said this is not possible. And when they started splitting their shares and...
Well, I remember the quote of that person you're talking about. There will never be $1 trillion company. Well, now there's...
At $2 trillion, and we're on to $3 trillion.
Yeah.
That's how quickly things are changing.
We're like 10 minutes into this. So I think the other thing we're hearing from clients is the election. What's that going to do to the markets?
Always get into a 4-year cycle. Here's the election coming. I mean, what do you tell people we haven't already told people? What I always try to say is we're not investing in the politicians. At least we're trying not to. Everyone makes a bigger deal out of that than they need to. And of course, we all have our own feelings and opinions, but every 4 years we're going to deal with this. All we want to see is me personally. I want to see some fiscal responsibility out of this country and out of the elected leaders. I hate to see people who are politicians, especially the lifelong ones, because they know how to sell it. And they get in front of people and all they do is promise, promise, promise. And they tell everyone what they want to hear in order to get their vote.
Right. And
they don't consider the long-term consequences to the rest of the society. Think about inflation. When you print the money that this administration printed as a cure-all for this lockdown, okay, and of course that was their decision. That wasn't anything that was required. That was a panic decision driven largely by the media, but then excitedly adopted by an administration who just wanted or thought that was the best approach. Lockdown, print money, 40% more money. Of course, you're going to have huge inflation. Of course, people are going to struggle now to buy groceries and to pay their rent and to pay their utilities. These are just silly mistakes that people that don't have any business background are making the decisions. So for me, I want someone or a group of people who actually know how economics work and that you can't just keep printing money. And you have to pay down what you've already borrowed.
Yeah.
$35 trillion.
Let me take the election one step further for you guys. I'm going to ask you this question for the benefit of the listeners. Instead of just concern about the election, we've had multiple clients or people that we talk to that have asked us about the aftermath after the election. People rioting in the streets like we saw in 2020. That's a real concern for some people, burning down businesses. Is it going to get that extreme? If so, what's the impact like on the market?
I don't know if it has as big an impact as the media wants everyone to think it's going to have. You're hearing about this civil unrest, civil war, if this candidate doesn't win or this candidate doesn't win. My approach, my view is whoever wins, Apple, Walmart, Home Depot, Chevron, Johnson & Johnson, all these companies are still going to open their doors for business the next day. So riots in the streets, we went through that with the January 6th thing. We went through it. Does everyone remember the BLM movement and all the riots in the streets there? Yeah.
Portland was locked down.
Portland was locked down. So, as far as how it relates back to companies, maybe where they do business changes, but they'll go find other places to do business. You're seeing right now, even prior to what you just mentioned, that scenario, Cade, companies moving out of these inner cities because of the theft rate. I forget what they call it on the earnings report. They don't say theft. They say something more politically correct, but it's stealing.
Yeah, it's stealing.
And they're just like, the hell with this. We're not going to operate here anymore. So some effect, but the good companies will figure out a way around that, in my opinion. And I don't think we go all the way where you're going to need guns, bullets, and clean water and iodine hid up somewhere in the hills.
I hope not. I mean, I look at the data and I look at the news flow just like every one of our clients, and it can rattle you quite a bit, especially when the media wants you to be rattled. So I look at it, I always try to remind myself, it's like watching a scary movie. You're watching a movie, but you still get scared. Like, what's going to happen here? What's coming around the bend? It's a movie. And this right here, even though we've seen it before, the media wants to build that fire and the anxiety and even the rage within all of us to the point where we are so opposed to each other. We can't even see eye to eye. We can't even talk or debate or have a conversation about it. I hate that about the media. And they are so conflicted in their reporting, and they want things to be destructive, and they want us to be that way. And they actually want this kind of unrest that Cade's talking about.
The divide.
It just gives them another story.
Yeah, I think a lot of people started to question their own beliefs in 2020. And of course, the market reacted poorly to the virus, but also it was the riots, like I mentioned. And my response is that the market was down 37% at one point. By the market, I mean the S&P, but it finished the year up 18% in 2020. So just because there's a short-term concern there with the election or what's to follow, remember that we're doing this for the long term and that these companies are resilient, like Shaun mentioned.
To wrap up, just remember, we're giving you some of the background on why the markets had a struggle, and these one-day events can quickly turn around. We've showed you charts about missing the top 5 days in the market and how consequential that is to your long-term returns. And that shows you, it plays right into that conversation, what happened this last week. Yep. If you got out of that market, you missed it all. And now you're sitting there wondering, and people they make comments like, I lost all my money in the market. Well, no, you didn't, because that's not true. If the market would have had to go to zero for you to lose all your money. That's never happened. All right. So don't listen to that and don't believe that. It's just people make silly and big time mistakes because they caved in. Their emotions couldn't handle it. They don't do the right thing. Got to do the opposite of what you want to do most of the time. So we expect a little more volatility as the media kind of, again, riles us all up going into the election. But we're hoping that people understand that these are normal and we're not shying away from things. We're making a few little adjustments and tweaks to the portfolios as we speak. Some exciting news coming out. We're getting ready to have one of our models. It's going to be tracked for performance reporting. So we'll be able to share all of that with you and other clients. And we're quite pleased with how it's performed over time. We'll share more about that as we go along here in the next couple of weeks. But any other final comments, boys?
I think that's good. Thanks for tuning in, guys. Appreciate it.
Thanks, everyone.
Talk to you again next time.